Um, so I could talk about income-based repayment. That was sort of the piece of this paper that stuck with me the most. Perhaps because, I mean, in a way you sort of frame it as there not being a finding around income-based repayment. And the finding that students don't understand income-based repayment is not surprising. But I was really interested in learning more about how you did sort of iterate through and try to reframe the language, like what you did exactly to try to help students understand it better. Because even though there might be structural issues with income-based repayment, sort of as Beth pointed out, there are systemic problems. There are always going to be information interventions that people are coming up with to try to resolve those issues. So I mean, sort of given that that's where we are, we have to figure that out. And that ties directly into some research that I'm doing with Angela Boatman and Brent Evans at Vanderbilt University. We are looking at the existence of loan aversion. We're serving a bunch of high school students to try to determine, it's really sort of the opposite question to what Jason and Alex have been looking at. We're concerned that there might be students who are not borrowing and so not accessing higher education or not persisting. But ultimately what we're planning to do, assuming that we find loan aversion, is an information intervention, probably specifically around the IBR. So, I mean, we're going to try to start grappling with that problem of how you explain to high school students what the income-based repayment program is. So,
yeah, and it actually struck me that one of the problems with income-based repayment is actually what we think is its sort of most novel feature, which is, well, I can't tell you what your monthly payment is going to be. It's just going to be an affordable share of your income. That's different for everybody. But people want nominal numbers. So they were sort of like, well, and you can't tell them. You can't, well, like, what are we talking, $100 a month or $200 a month? And then you end up in this percentage of income. And we have to walk back from the 10%. It's not really 10%. It might be 2% or 4% based on the exemption. You get into the weeds right away. And so we tried to go with, well, how about less information? How about we give them less information about them and try about income-based repayment and say, it will be an affordable share of your income. And so they became very suspicious of this, where they would say, well, like what? What does that mean to you? And that might mean something different to me. And so we realized, well, that's not getting us anywhere either. So it was pretty difficult. And some of the student loan servicers and the collection agencies have mentioned to me, and this was made, I thought about this in a very different way, what we experienced in these focus groups. Now, mind you, we had paid these people $100 each to come and talk to us for a couple of hours. So they were very, they were in a good mindset. They wanted to talk. They had snacks. They had $100. They were willing to try to figure out, what are you talking about with income-based repayment? Now imagine someone who has defaulted on their loan and a collection agency has been calling them every day for a week, and they finally decide to pick up the phone. And this collection, this conversation, the explanation of income-based repayment is not going to go well. The borrower is not going to be really receptive to the details. And also, I should point out, in order to use income-based repayment after you've defaulted on your federal student loan, you first have to make a series of payments that aren't based on your income necessarily, and then transition to income-based repayment. So it's a little bit of it's sort of great on paper, but when you hear about how it works for borrowers.
Well, do you think making IBR a default, especially once somebody has defaulted on their loans, what do you think? Do you think that's a viable policy solution?
So I think some of this goes to Beth's comment that is sort of assuming that they have defaulted because the payment is too high relative to their income. And I don't know that that's the case, considering all of the other explanations of sort of default that we have in here, like resentment, the sort of, it was a $10,000 loan and now it's $30,000, and I don't want to pay based on my income or anything else for 20 years because I didn't borrow that much. So I don't know what and I think there are some pretty big sort of technical hurdles and administrative hurdles to just automatically enrolling somebody in that. I think that would be difficult. Most people who are defaulting on very low loan balances. And so IBR may not actually even lower their payment.
Yeah, in my experience, I've found that in working with nonprofits that specifically target low to middle income families and help them, economically empowered, get on their feet, they're actually averse to recommending people utilize IBR because of the long-term costs associated with the growing interest, even if you have the discharge or forgiveness option. And I remember I was puzzled because it was one of those train-the-trainer presentations where you're explaining, the new rules and regulations regarding student loans, doing case studies and scenarios. And a woman shot up her hand. She's like, "This is completely antithetical to what we tell our clients." And I was like, "Really? I'm sorry, because I thought that this was actually somewhat helpful." I mean, I can see why you would say that, but then I went back to the drawing board, and so for the next time I went there, I had this pyramid based off of Maslow's hierarchy of needs, and then I was like, okay, right, you're focused on food, shelter, and these basic needs, and you even if you have this tool in IBR to help with the student loan, you're looking at how this negatively impacts all these other things. So let's.
And you're saying the negatively impacts in that the balance grows and you're going to pay more in interest overall or pay for a long time?
Correct. I think they're just looking at, but it's put to your point about in the paper, people are looking at the 20 years versus my point is that just because you sign up for IBR doesn't mean you have to do it for forever. It could be like deferment or forbearance, a temporary adjustment until you get to a place where a standard repayment would be more feasible.
So we run into this problem too when we were talking about IBR, because you mentioned 20 years. That's when the forgiveness happens. But people hear, I pay for 20 years. Right? So income-based repayment is you pay based on your income. You may pay off your loan in 10 years. You may pay it off in 12. If you haven't paid by 20, then it's forgiven. But they hear 20. And people think you're making them pay for 20 years. And so it's interesting to hear you say that. So that was a hurdle. I think that's a big hurdle for the programs to get people out there. Go ahead, Beth.
I'll come back to the theme of student loans are different. And maybe I'm reading between the lines too much, but I guess that's what we all do here. I'll interpret it in our own way. But what seemed to me is that there was a comfort that the individuals that you talked to had with these other financial obligations that they had, whether it's their Netflix account, their car payment, their mortgage, these things. And the sense I got was that there was a recognition of the safety valve in those cases. If I don't have money for my Netflix, I can cancel that. I can get rid of my cable bill. If I crash my car and it's totaled, it gives me no more value, I stop making payments on it because insurance comes in. And there seemed to be a clear distinction to me that safety valve either is not there or it's not perceived to be there by the people who you're talking to, and that is the difference, right?
Right, but what you were seeing though is that this. Now we did partially screen people in who had said they'd use forbearance, but people were finding their way to forbearance as this way to just make the payments stop. And I mean, I think one of the things that really came out of this for me doing this work was I want to know a lot more about the forbearance benefit in the student loan program. Sort of who's using it, how long do they use it for? Again, because interest accrues on the loan during this time. So you can imagine someone who has a 10-year repayment plan. They postpone payments because they were unaffordable, or they thought they were too much, and I'll figure that out later. They use forbearance for a year or two. Whatever wasn't an affordable payment 2 years ago just got larger on account of using forbearance. So just the discussion about it and the way the borrowers talked about it, I really want to, and also, does forbearance just lead to default? Like that. So in terms of doing focus group work to generate questions about what data I think we really should try to get from the Department of Education, or the Department of Education should put out is, are people using forbearance and their just balance is growing and then they default on a larger balance? Which I think, did you get, maybe a question for you three, did you get the sense that this leniency, I don't know if there's not really a better term for it in the loan program, hurts people?
Your paper uses such a specific sample, which I think is really interesting. But thinking about, forbearance and deferment more broadly, I think if you had a big national data source, which maybe Beth knows what a big national data source would be that would identify that, I think that, I don't know, I would hypothesize that you wouldn't find the patterns replicated that you see in this particular qualitative sample that you have.
So you would think that if we were to get data on forbearances, we would see that people are actually using it the way we expect
On average.
on average. But forbearance is really, I mean, but do you think we should have tighter limits to it? I mean, 3 years seems like that seems like a sort of dangerously long time to let somebody not make any payments on the loan. Do you, or I mean, it sort of made me rethink, like, is this, and there's information in here as well that I thought really countered the view in Washington that consequences for not repaying your loan or being in default are really swift and severe. The borrowers made it sound like things were dragged out over much longer periods of time. So my question for you guys is, do you think that's really what's happening, particularly Kevin, because you're talking to a lot of these people day to day, and also, you know, is that bad that we actually let this drag out? Would it be almost better, as somebody actually used the phrase with me the other day, sort of failing fast as opposed to letting the sort of problems drag out and fester?
I'll go first, and then Kevin
Okay.
can tell you the real answer. But you know what I think it reflects. I don't think we can sit here and say what the appropriate duration of forbearance should be. We haven't, thought deeply about that question. But what I think we know is that we need a more robust, coherent, simple program of safety nets for federal student lending. And so what you're seeing is cobbling together of this forbearance, which was designed for one reason, probably being used for a different reason in a lot of cases, and then trying to connect that with income-based repayment, and it just sort of junks up the process, is my guess. And so what should it be? I'm not quite sure, but I know it should be part of a comprehensive system of a safety net for federal lending.
Yeah, I would just say in my experience, so I say this diplomatically, the servicers or the people who hold the loan are the one with the knowledge about the process, tend to be in a more advantageous position than the person who has the loan. I'm trying to say this very diplomatically, so just bear with me, please.
Well, when you're done, I will
Loosely translate
yeah,
for me.
I will say what you
Okay.
really want to say.
Great. And I say that because it really highlights, I guess, the difference between servicing and counseling. Like if you call a servicer to get assistance, they're a volume business, right? It's how many calls can I get rid of in my time here, and I need to churn through these as quickly as possible. What's the easiest thing that I can do if somebody's experiencing difficulty repaying their loan? Tell them about forbearance, okay? Then it kicks the can down the road, then you feel good that you did your job, the person feels good that they don't have to pay, everybody's happy, and then check back with us in 12 months, 24 months, 36 months, right? But when you counsel somebody about their options and you actually take, instead of having 20 calls in an hour, maybe you have 3, but you're spending 20 minutes with each person going over the pros and cons of each of their options relative to their situation, their scenario, talking about if they want to go to school down the road, if they have a family, et cetera, building out all these options. That's a much more comprehensive approach, and my argument would be if that was the case, on a much broader scale, you would see people taking advantage of different options other than just doing that because they felt that they had nothing. And so as the conversations shift in the city about, well, how are we going to implement financial literacy? What does that mean? Or I would just argue that there needs to be a focus on the difference between servicing the loan and loan counseling, and putting more effort into building up the counseling. And I always use Zappos as an analogy of customer service. I personally don't shop there, but people who don't even like shoes just want to call the 800 number just to talk to somebody friendly. Like, I don't want to buy shoes, but I heard your customer service is legendary. And just sit on the phone. But I mean, that it's that idea that yes, there is a myriad of options, but when you take the time and you don't just put somebody in it because it's convenient, then you would see different results. And I don't know, it's always difficult to say what is going to be statistically significant, because I don't want to say numbers can lie, but numbers can be a little misleading. When you look at the statistic a lot of people throw out is, well, there's not really a student loan crisis because less than 10% of the population has debt higher than $40,000. But if you look at it one of the analogies I tried to make is like with the wind chill and the heat index. I mean, it can be 98 degrees outside, but if you have relative humidity of 70%, it can feel like 122. So in other words, lower balances may not seem like a big deal from like a policy perspective or just casual observer, but to that person who might be low income or has these other financial responsibilities, that burden actually feels more than it appears. And so I think, in my opinion, and the evidence would show, a lot of times the quickest and easiest solution isn't always the best, but it's the one that they're steered towards because of the incentives on this end, on the servicer end of the lending contract.
Sure. And so you're saying sort of steered towards doing forbearance rather than what?
Rather than, I don't know, deferment, like thinking about how to pay if what the standard repayment would be. Now there's public service loan forgiveness, loan consolidation, graduated repayment. I don't know. There's options, and I just. It's very difficult to see how something can be crafted and designed in great theory, and you see the unintended consequence of what happens on the ground. And I think the time that it takes in between when the policy is implemented and when you realize what's actually happening and understand those unintended consequences and do your best to remedy them, it's not like lightning quick. Like, not to get into the culture wars, but like Indiana, where something happens, let's pump the brakes on that and then turn it around. Like, and when it comes to these types of issues, it's important for work like this to show what's happening on the ground level and people's responses to these policies, and sort of use that as input in how you craft future ones.
What do you think would need to happen in order for the level of counseling that you're sort of advocating for to start happening?
That's a very good question. What do I think would have to happen? Well, I guess I've condensed my job title to a 15-second elevator speech. Like, what do you do, Kevin? I work to deflate the student loan bubble, right? So I guess if it popped, then maybe there would be some renowned emphasis on counseling. But I think if organizations that already do it, such as ours, provide evidence that it actually works and get more buy-in from our state legislature, and then our Commonwealth can be an example for other states, then hopefully get some momentum that way. But ultimately, it's going to come down to people having their voices heard and really informing policymakers what's happening.
So we had a section in the paper where we were sort of skeptical that this is a counseling information problem. It didn't really strike us that people were ending up in the situations that they were in because there was something that they really didn't understand about the loan program. And to a certain extent, you heard people, when they were sort of clamoring for more information, what it sounded like to me, and I guess this sounds a little bit harsh, was, it turned out that this thing that I did was actually risky, and it turned out to not go so well, and I would have really liked to have known how it turned out before I made my decisions. Which is more information, but it's sort of more information about how the future will turn out. But I'm wondering for the three of you, if you saw this as an information problem, and if you could sort of specifically what would we provide that would sort of change things here, or what is the information problem for these individuals, do you think? Or you can speak more broadly about the loan program in general.
I'll answer that. So I actually am less pessimistic than you, for once maybe. I think it's not just the information about the future outcome, which is sort of the pessimistic view, right? That they recognize the upfront costs, but are just uncertain about the future, which is just natural, and we can't ever resolve that, right? I think it's actually more of a solvable problem than that. And just to bring in some data points from my recent paper with Matt Chingos at Brookings, what we found is that when you ask students in their first year of study how much debt they have and how much they're paying to go to college, they have absolutely no idea. So the statistic is that only half of these first-year freshmen that we looked at, among this national representative sample of first-year full-time freshmen, about half significantly underestimated the debt that they had taken on thus far. So this is within less than 9 months from having signed their first promissory note, and they just have no idea how much debt they've taken on. So they have uncertainty about the future, and I'm sure everyone would have liked to have that resolved up front, but they still don't even know the other side of that equation, or how much that investment is that they're making. So to me, that's a solvable problem, and then information about the risk is something we can address too, but that's sort of secondary.
I almost think it's a rebranding effort versus giving more detailed information. For example, when high schools have their financial aid nights, I go out and speak to parents and students. And one of the things I found that's been resonating is two things. Well, first of all, saying that this is a business decision. I want to help you become wise consumers so that you understand you're purchasing something, a product, and you want to get a good return on the investment. But another thing that I found myself saying is that rule number one as a parent is keep your kids safe. And we can conceptualize that by, I'm going to take your keys so you don't go to that party out at the site at 2 a.m. And all these other scenarios about personal safety. And so what I've tried to do is say, let's look at this as, how do you keep your kids financially safe? How do we expand the definition of personal safety so that you protect their short-term financial interests and long-term financial interests? And oh, by the way, yours, that you're not borrowing from your retirement or refinancing your house to pay for this investment. And it's like the light goes off and it's like, wait, oh, yeah. Well, if you put it in those terms, then perhaps maybe the choice to invest X amount in this particular school may not be the wisest. Maybe it's, if we're ultimately looking at this is going to be a credential to help me get a job later on down the road, perhaps there's a different way to do it. And I close and just say, you know, where your son or daughter goes to school is not a reflection of how well of a job you did as a parent. I think a lot of parents would sort of see it as like their capstone project, you know, or their senior thesis, you know, where their kid gets to go slapping a bumper sticker on and say, yes, this is validation, I did an excellent job. And, you know, particularly in the Northeast where it's very, very competitive at elite institutions. And even non-elite institutions, it can be sort of competitive, right? And so there's this idea that it's this personal reflection, but if you say, okay, let's expand the definition of personal financial safety, and let's not view this as sort of like this validation or rubber stamp on a job well done, and start from that as your baseline, then the parent who I saw 2 nights ago, who's looking at me with 3 different financial aid letters, all from schools that are like, you know, $50,000, fine institutions, but have gapped them by $25,000, would rethink and say, well, perhaps we should take a year off. Maybe I'll look at Middlesex Community College, which is an hour from my house. And I mean, from also, I would say too, from the school's perspectives, one thing that I find interesting is how they operate as businesses sort of may be counterintuitive to what is best for the consumer, which I guess is obvious, right? They're a business, they have their principles, they have their goals and objectives. But one of the things I found interesting is the schools that require students to live on campus their first year. Like why should that be mandatory? If a family wants to save money by commuting and it's feasible for them, like you shouldn't require a student to therefore pay $13,000 or $14,000 in room and board to live on campus. I mean, especially if it's an urban school, you're trying to create a campus community in a larger city. I mean, it really doesn't make much sense. But
this is what Kevin Carey is finding with his book about the end of college. People are like they cede the academic quality argument right away. Oh yeah, academics, so you can do that anywhere. But the community. So, which is sort of like, is everybody in the United States just agree that college isn't about academics?
Right. So my point is that it's information is a part of it, but I think it's a whole rebranding of what are you expecting out of this? Understanding that this is a consumer decision. Okay, this is you are making a purchase. And for many people, again, I can't stress this enough, this is the first time they're paying for school ever. If you're paying taxes, you're going to public school, the idea of paying for college, it's all a foreign concept. Like you think about it, you know it in your head maybe if you're a parent and you went, but the landscape was miles different back then, miles, and it's changed exponentially, and so that would probably help towards, I think, the information challenge.
I can't resist talking about the community issue that you guys were just discussing. I mean, there is research that shows that, you know, building communities like that does help with persistence. And part of the issue with these students repaying their loans is a persistence issue. If they don't persist to a degree, that makes them more frustrated with their repayment. So I don't think we can totally discount the community idea. But more to the point, I totally agree with what Kevin was saying about framing, and that a lot of these issues that you bring up in your paper are a framing issue. And I was particularly thinking about that with the point that you bring up that students, were low prioritizing these loan payments, which I think was kind of possibly the most striking finding for me in your paper. And that could definitely be a framing issue. Definitely, Beth was kind of saying this before as well. Why it is that you have to keep making these payments even though you're not receiving a service is definitely a framing problem.
Yeah, and it's funny when they said that, and I thought of it as well. I finished graduate school a long time ago, and I can tell you there are definitely months where that $200 comes out of my checking account, and I'm like, what is that again? Oh, that, yeah, that was a long time ago. So I even, and I know better, right? So I can certainly see how there's definitely a different attitude toward it. But do you think, you all talked a lot about the sort of information on the sort of front end, on sort of preventing, right? Like making sure people end up with, but we spent a lot of time talking to people who, had already made those decisions, and we were talking about sort of managing their loans. So I just wanted to make sure, was there something is there an information problem there? It struck us as people